The broadcast is now starting. All attendees are in listen-only mode.
Good evening, Marshall Reddick members. This is Tanya Lorimore. I'm a real estate advisor here. I am so excited about this presentation. It is the hugest part of investing, getting yourself ready to learn your lending power and what is new in real estate investing for the lending side of it in 2015. So we have our guest speaker here. His name is Reed Hazard, and we've worked with him for 10 years. So all you guys that are on here, so many of you on here, have probably shook his hand, already met with him, as well as myself. So no strangers here. We enjoy what he does. He has a full team that he works with. Most important thing about him in his, I feel it's the beauty of what he does is he's a direct lender. So what that means in conventional financing is he's not restricted like some major banks are only restricted to certain loan programs. So we're focusing today on residential financing. That means 1 through 4 units. And so he is an expert at what he does. You know, and if you guys, after watching this presentation, do not qualify for conventional financing, that's okay. As your real estate advisor, I will have options for you as well. But Reed at AmeriFirst is going to have the best rates for you conventionally that will make the most sense for you. My contact information will be at the very end, just like Reed's. So without waiting any longer, let me introduce Reed. Reed, are you on the line?
Yes, I am. Hello, Marshall Reddick members. So nice to be here this evening. Happy New Year to everybody. I'm going to make this as detailed as I can, but also to the point. Many of you that I'd spoken with after the past investment seminar that I did online were asking, well, I really want to know what's going to happen with Fannie Mae, Freddie Mac, meaning conventional mortgage rates, the rates that are the lowest out there. In 2015, what's going to happen after the Fed stops with their bond buying program? What can we really expect in the future? And unfortunately, because I'm not the Fed chief, because I don't set rates, and I only get verbiage that comes across from Fannie Mae, Freddie Mac, FHA, and VA on a monthly basis, I can only update what I have whenever it comes over from them, and it's about the same information we had last year, but there are some new market updates and a few minute changes that I will be going through this evening. And then anybody that has additional questions after the seminar, please do call me and we can discuss it in further detail. So a little bit about myself. I specialize in 1 to 4 unit property. I don't do commercial property, but if you do want to do a commercial loan, I have a fabulous referral for you. Also, if you do not qualify for full documentation financing, meaning where you have to supply your income documents and your asset documents and run your credit. If you don't qualify based off the guidelines I'm going to go over on this webinar, we do have other programs available for you that may make sense. Okay, so again, this is more geared towards the investor that wants to get the highest cash flow possible that's able to qualify with Fannie Mae, Freddie Mac financing. So again, a little bit though about myself. Bought my first investment property when I was 19 years old. I've been with the Marshall Reddick Network now for 10 years, just this past month. And I'm federally and state licensed to lend in California, Texas, and in Arizona. And my branch is licensed to lend in Indiana and Tennessee. So that covers 5 of the markets that the network invests in. If I can't lend in a market that you want to buy in, we do have a referral either through the network or through myself. Okay? As well as myself, Brett Gilliland, okay, is my loan officer that I have that helps me out in the network. Brett's been working with investors for over 10 years. He bought his first investment property when he was 29. He's 42 now, has 2 children, great guy, and you'll either be speaking with myself or with Brett when you're doing financing here in the network. Okay, rates. So everybody wants to know what's happening with mortgage rates. We're going to go over that here a few slides later. But I just wanted everybody to really see, really put it into perspective how low interest rates are right now. Okay, rates back in the 80s, early 80s were at 18.45% at the peak. Some of you were buying property back then. Okay, now CDs back then, if you parked your money in a bank, were also paying 18%. So everything is relative to its environment. Understand that. But mortgage rates at 18% for a 30-year fix, it's unbelievable. Right now, rates are the lowest that they've been in the past 12 months. I'll go over that here a few slides later. But just know if you're buying a primary residence right now on a no-point loan transaction, which has very, very minimal loan costs, you can get a 4% rate on a 30-year fix. You can get a 3.75% rate with paying 1 point. Okay? You can do a 4 1/4, 4 1/8, and pay no cost for your loan. So very, very good time still to be buying property, either to live in or obviously for investment property. Investment property rates are the lowest they've been in the past 12 months. You're looking at about a 4.375% rate today with no points. Down from about a 4.75% that we saw a few months back. Now, obviously, why are rates so important? You know, if you're buying as an investor, you're buying obviously for appreciation over time, but really for cash flow, right? And you're also buying because that investor is going to pay your property off for you. Okay, over a 30-year period, if you never refinanced your loan and you were able to keep a tenant in there most of the time, right? I mean, every once in a while you're going to have a vacancy. But let's say that 29.2 years out of that 30 years you're able to keep your property rented, that loan's going to be paid off free and clear. Now, why rates are so important, of course, as you can see in this chart right here, every 1% rise in interest rate is a 12% rise in your monthly payment. So obviously we want to take advantage of the lower rates while they're here. Now, the market update that I wanted to kind of go over today. So, quantitative easing, okay, that was the Fed's bond buying program where they were buying $85 billion a month in bonds. $45 billion a month of that was mortgage-backed securities, right, mortgage bonds. $40 billion of that was treasury notes, treasury bonds. Like any of you that watch the stock market, you'll see the 10-year treasury note, the 30-year treasury note, the 7-year, the 5-year treasury note, okay. They were buying $85 billion a month up until February of this year. And then Janet Yellen decided to start tapering back on that by $10 billion a month, meaning $75 billion in March, and then therefore all the way until October, where we ended the bond buying program. The last purchases were near the end of October. Now, the Fed is still buying bonds. We don't know at what rate, but we do know that the reason why rates are still low at this point is a lot of economic data across the world is nowhere near as bullish as the market data that we see here in the U.S. For example, the U.S. is really doing well right now. We're really showing growth again. The third quarter of last year, the GDP, which is gross domestic profit, or gross domestic production, which shows how much that we've grown as an economy in that quarter, was revised to 5%. That's the largest reading we've seen since the third quarter of 2003. Okay, so that is tremendous growth, whereas areas like Russia are having a very hard time right now due to the oil issue that we have going on in the world because of the low demand for oil. So America's doing great, guys. But at the same time, the bond market, okay, puts their money in the bond market as a safe haven, okay, and bonds are a great buy right now when you have issues like what's going on in Russia that could negatively impact our markets. Okay, so the bond market is definitely a safe haven and being used as one. Okay, and the bond market is looking specifically for guidance from the Fed chief, Janet Yellen. Now, just one or two words that she says could affect rates dramatically right away. For instance, I put here on my third notation, current verbiage is we will remain patient in the Fed's approach to raising rates. Last time she came out, she said, hey, we are going to wait patiently to see what the economy does for the next quarter, okay, before we give you guys any idea of exactly what time frame that we are going to raise rates. The bond market works 6 months in advance, okay, so they want to see what's going to happen 6 months from now, okay. The previous target for when the Fed would be raising the federal fund rate was 6 months after quantitative easing ended. That was in October, right? So we're thinking it was going to be in April. Well, she came out at the end of the year and she said, hey, you know what, we're now going to still remain patient. It wasn't the verbiage of we are going to, if by the end of this date we see unemployment at this level, we will be raising the rate this amount. Nothing like that was said yet. There's nothing that's been definite. And that's the reason why the bond market is still doing so well right now. Okay. Now, Janet Yellen is not hawkish, meaning that she is much less conservative right now on buying bonds, and she's not as big on raising rates too fast, okay? She's a dove. That's a good thing for us that are buying property, because that means she wants to wait until she sees GDP consistent, until inflation's back at safe levels, and until employment levels are around a 5% or below unemployment rate. So that's a good thing for us, okay? Rates could stay low another year and a half. I would say they're probably going to stay low throughout this next year, and then we'll get some verbiage from her towards the end of the year, depending on what the markets do. That's just my opinion, okay? Then we'll probably see her come out with some specific verbiage at the end of this next year, or maybe in the third quarter. And at that point, when any verbiage comes out that gives the bond market any notification that, hey, in 6 months, they're going to definitely raise it at least a little bit. Right now, the federal fund rate is 0 to 1/4%. If that verbiage does come out, when it does come out, you'll see the bond market automatically start to sell off a bit and rates start to tick upward. Now, very quickly, when I say the Fed raising the rates, so we all understand, the federal fund rate is the overnight rate at which banks and lending institutions have money lent to them from the Federal Reserve. Because Bank of America can't lend you $400,000 on this loan, $500 on that all day long. Otherwise, they run out of money, right? They have to get the money from somewhere. Well, they get it from the federal government, and they're making a killing, right? They're not paying anything for this money right now. Okay, so again, the federal fund rate, that controls all types of financing, auto loan financing, credit cards, mortgages, you name it. So again, that federal fund rate, that's what the market is looking for verbiage on. And again, the verbiage right now is that we are going to continue to remain patient, okay, and watch what the markets do, both globally and within our own economy. And then when the next Fed meeting comes out next month, we'll see what she says. Okay, so that's the market update. And now I want to roll into getting pre-approved now. Getting pre-approved for Fannie Mae, Freddie Mac financing, which is called conventional financing. When you go online to bankrate.com or to any of these different sites where you're able to gather lending data and rate data, just know any rates in the 4% range, low 4% range, those are all going to the same place, rather that those loans are being underwritten off the same guidelines, okay, with the intent of being able to be sold to either Fannie Mae or Freddie Mac, okay? If the loan amount is above $625,500, now you're dealing with a jumbo loan, okay, and it's a little bit of a different process, and we can discuss that. But those rates even right now are in the low 4% range because those kind of follow what Fannie, Freddie, FHA, and VA are doing, okay? Now, getting pre-approved. The 5 required tasks in getting approved are, you take an application, okay? When you speak with me, we can do it over the phone. It takes 10 minutes. Or you can go to my website, which is www.reedhazardloans.com. Click on the Apply Now tab. It takes about 10 minutes to complete. Once we do an application together over the phone, we have to run credit, okay? If you're not going to buy in 6 months, you don't want to run credit yet, that's fine. Run your own credit. Send me a copy of the report. I'll look at your financials, and we can build a game plan for buying later in the future. But if you're going to be buying property within 90 days, you do not want to do a quasi pre-qualification. You want to get fully pre-approved up front, okay? And the process is credit must be pulled. If you're getting it ran through 5 different companies, yes, it will deteriorate your score. If you're running it with one company, it's not going to affect your scores, okay? We will then run the credit report and all of the credit findings and the application through an AUS, which is an automated underwriting system, through Fannie Mae or Freddie Mac or FHA if it's a government loan. Whatever type of loan that you're applying for, we run it through their system and ensure that we get what's called an approved eligible. Based off of the approved eligible, we will then be requesting supporting documents like W-2s, pay stubs, 2 years of tax returns, okay? If you don't need us, or if we don't need to qualify you with tax returns because the AUS only wants W-2s and pay stubs, we can go that route. But for the most part, if you're buying investment property, okay, everything's based off of a 2-year continuance or 2 years of where you're at. So 2 years of rental history or 2 years of employment history, 2 years of credit history, okay? Once we have all the documents from you that we need for review, we will then submit your loan to my underwriter, Lee Tiska, who is in-house, okay? She will review your file and issue a fully underwritten conditional loan approval within 24 hours of receiving all of your documents. I will then submit an approval letter to you based off of what you can qualify for. Then when you find a property, okay, and it's a specific property that you guys want to buy, and you have the address, we'll input the property address into the letter, we'll make the offer specific with your offer price and loan amount. All those details will then go on the approval letter and will be given to the Marshall Reddick agent that we're using for the transaction so they can submit your offer correctly. And on top of that, we're able to put on that letter that we can close in 21 days or less because you're already conditionally loan approved. On a primary residence, we can do this in as little as 10 days. What this does for you is because you're fully approved up front, a seller goes, okay, these guys are serious. This is as good as an all-cash purchase. All we have to do is get an appraisal, a copy of a home inspection, of course, and then a copy of the title report showing that there's clean and clear title on the property before we can submit your loan back in for a final clear to close. Okay? There may be another pay stub needed or another bank statement, but for the most part, once you go through our pre-approval process, getting to the closing table should be fairly simple for you. I don't need to really go over this, but I'm happy to just for a minute. This is just most banks and institutions, because they don't get paid off you, right, until we close the loan. I'm an independent contractor. So is a bank in a sense. If you don't close your transaction, they don't get paid because we can't take an application fee up front. So most people will take an application, run your credit, maybe run an AUS, but probably not. They'll just run your credit, look at all the numbers, and go, okay, it looks good. Send you a pre-approval letter, which you think is awesome because you're going, wow, that was easy. But then when you get in the purchase process, let's say that you're self-employed and maybe you have declining income this year and you have 2 investment properties that are not rented, but there was income on the tax returns, so the lender approved you based off that. And now you're in escrow, and now they're going, well, we need this, otherwise we're going to deny you for the loan. And you've already paid $600 for an appraisal because an investment property appraisal also requires an additional document called a 442, which is a rental comparable analysis. So that's $600. And now you're being told that I might be getting denied for this loan. Okay, that's what we don't want to go through. Okay, the lender doesn't want to go through it because they've spent their time on it, and you, of course, don't want to because you're trying to buy a property and you've spent your time and you've gone through all your documents, and it's a nightmare getting all this stuff together sometimes. Okay, and you've spent money out of your pocket. So do it the right way, whether it's through myself or a different lender. Go through a direct lender because we have complete control of the file, and go through a true pre-approval basis up front so you don't run into any issues when you're in escrow. Now, how to close your loan faster. Some of these things that I have listed on here are very vague, so I'm gonna try and quickly explain them to you. But after we've already initially ran your credit and gotten you fully approved up front, okay, don't apply for or open new credit of any kind. Okay, if you go and you open up a new credit report, and if you put a balance on there, the underwriter prior to closing does what's called a light pull of your credit report. And if they see additional debt on there, we now have to get a credit supplement showing what you owe on it. That minimum monthly payment gets added into your debt-to-income ratios. And in some cases, it can unqualify you for the loan. Let's say that you go and you buy a new car. It's got a $300 a month payment on it. But you don't think that the underwriter is going to find out because you're already pre-approved. It's not true. The underwriter will always do a soft pull of your credit prior to closing. And that payment will be factored into your debt-to-income ratios, which I'll go over here in just a minute what debt-to-income ratio means. So if you're going to do anything after you've been pre-approved, just call your loan officer and tell them what you're going to do so we can factor in that payment with your other debts, and that way we don't have any issues if you do open up that account mid-process. Okay?
You know what? Actually, I have to really emphasize on that with Reed. Don't try and make any purchases or open any new accounts. The underwriter will find it. All right, I just had to interject there.
No, absolutely. And, and again, I have my own underwriter. She's a sweetheart. She's great. But at the same time, she's a DE underwriter. She's designated, and she's licensed, and has to follow what she has to follow. And, again, if you add credit and if they find out about it, we have to add it in. So very, very important. Don't max out or overcharge on any of your current credit cards. Again, they do the light pull. So whatever your balances are towards the end of the process, that new minimum monthly payment is going to get factored in. So just try not to use your cards any more than you already do. And don't make any large purchases when you're going through the loan process, unless, of course, you call me. I mean, hey, if your lease is ending the month that you're doing a purchase and you got to go lease a new car, just call up Reed and say, hey, Reed, payment's going to be $400 a month. Is this going to affect my loan approval? I'll tell you right away, and that way you guys are safe havened. And don't make large deposits in any of your accounts. That's a little vague right there. Again, I mean, if you've got money coming in that can be sourced and you're depositing into your account like a $7,000 check from a friend that you'd loan money to, they're just going to want you to explain where it came from, okay? And the reason why is when you're buying an investment property, you're not allowed to use borrowed funds for the transaction, okay? So unless it's from a home equity line of credit. If you're using funds from a home equity line of credit tied to another one of your properties, that's the only type of borrowed funds you can use when buying an investment property, okay? But gift funds are not allowed on buying an investment property, okay? And again, when you have a lot of large deposits going into your accounts, the underwriter is going to want to see where those funds have came from. So if you're getting into the purchase process and you want to limit the amount of documentation that you need to provide, it's better that you try to use the same accounts that we're using for down payment. Try to keep the account activity a little bit lower on those accounts and deposit the funds into a different account that we don't have verified. Otherwise, it's a little bit more of a documentation nightmare. They need to source where the funds came from, and you have to write a letter of explanation on it, okay? So if you're trying to buy an investment property with $40,000 because you're a bartender and you've been saving that cash $1,000 a month for the past, 40 months, put that money into your bank account, okay? Let it season until we have 2 clean bank statements, not showing the initial $40,000 deposit. That way it doesn't have to be sourced and explained. Now you can buy investment property. Same thing if you want to buy with a partner and you want to equity share. One person has great credit, one person has a lot of cash. But you want to buy together? Okay, so have the cash partner deposit those funds into the credit borrower's account that's actually going to be on the loan. Let's wait for 2 months till everything looks like it's all the credit borrowers. That way we have no issues moving forward. Okay, and this is a little bit confusing, so again, that's why I'm here. And after the presentation, call me, email me, and I can explain that further for you. Things to do when you're in the purchase transaction process. Do maintain employment at your current job. Okay, I had a doctor that was W-2 making $175,000 a year that got partnered throughout the transaction and was now making $285,000 a year, but those funds were 1099, meaning that now he's self-employed, meaning now we don't know what his write-offs are going to be. He's not a W-2 employee anymore. We can qualify you off 1 year's tax return if you're self-employed, okay? But in this scenario, it kiboshed the deal because he's not a W-2 employee anymore. He's now self-employed. We would need to have had 1 year of income returns with him being self-employed. So if you're going to have to change jobs throughout the process, try to make sure it's W-2 to W-2 and in the same line of work. Otherwise, we could have a problem. Okay. Do keep all of your existing credit card accounts open. Whenever you close an account, it can negatively impact your score. And when they do the light pool, if the scores come in lower, it can affect your interest rate and so on. Do pay off collections, judgments, or tax liens reported within 1 year. When I get your guys' credit report up front, I'll be advising on that. Okay, if there's anything like that that's derogatory on there, I'll also send you a copy of that report for your records so you guys can review it. And do stay current on all existing accounts and financial documents. If you're late one time, 1 30-day late on a credit card, it can drop your credit scores as much as 100 points, okay, depending on your credit profile. Now, moving on to the down payment requirements for buying investment property, okay? The minimum down payment requirement with no mortgage insurance is 20% down, okay? Now, the FICO score requirements have gotten better, which is good. Credit's been loosening, okay, a little bit for Fannie Mae financing. You can qualify with as low as a 640 mid-FICO score, okay? That's on a 1-unit property. Now, minimum amount down, 20%, that's on a 1-unit property, a single-family residence. If it's a duplex, triplex, or fourplex, like 2 to 4 units, it's going to require 25% down. But you can still qualify with a mid-FICO score of 640, okay? Now, if you have 5 to 10 finance properties, so you already have 4 finance investment properties and 1 primary residence, okay? And you're going to buy your 5th investment property right now, and you already have your primary. the minimum amount down is going to go up by 5%. Hold on one sec. Hey, you guys, I'm getting a lot of feedback. Can we not talk? Thank you.
Chimney, and then we align our...
Okay, so 1 unit property is going to be increased now to 25% down, okay?
I think it looks
2 to 4 unit, 30% down, and you must have a mid-FICO score of a 720 in order to qualify, okay? Very quickly here, this is what lending is based on, okay? Whether you're buying an automobile or whether you're buying your home or whether you're getting a credit card, that's why they ask you what your income is and what your debts are. It's called a debt-to-income ratio, okay? How do you calculate your debt-to-income ratio, okay? You divide your monthly debts into your gross, which is your pre-tax income, okay? That will give you your debt-to-income ratio. Now, the debts that are included, okay, and this is based on monthly debt. So it's not like if I owe $5,000 on an Amex card, we're not going to take $5,000 and add it on to your other debts, right? It's whatever the minimum payment is on that slip that you get every month from Amex, okay? So it's minimum payments on credit cards, auto loans, mortgages, okay, including the taxes and the insurance on that property, student loans, any other loan that is on your credit report that's tied to your Social Security number, those are all going to be included, okay, in your monthly debts. Debts that are not included in DTI include auto or health insurance, cell phone and utility bills, loans to family and friends that are not recorded, and then business loans that are tied to like an EIN number. Like if you have a credit card on your business, that's not going to show up on your credit report. We don't know about it. That's not going to count. Okay. So again, DTI, extremely important, especially when you're buying investment property and when you're doing a mortgage. The DTI requirements for investment property. So you guys can all find out tonight even if you're really interested exactly what your DTI is. 640 to 660 mid-FICO score, the max net income ratio is 43%. 660 to 680, max is 45%. 680 to 700, max 45%. And if you have at least a mid-FICO of 700 or above, it's 45 to 49.99% is the max I can get it approved to. Now, when I say FICO score, remember, I'm talking about your credit scores through Experian, TransUnion, and Equifax. Those are the 3 credit bureaus, okay? When you run your score on your end, not going to be the same as when I run my score on my end. Always know that, okay? Are they going to come in lower on my end? Not necessarily, but when a creditor runs your credit, it's always different than when you run your credit on your end. That's why if you've ever gone to go and buy a car, and you're like, wait, I have a 720, and they're going, no, you're at like a 680, that's because, again, it's just different when you run it and when you're a creditor. So just know that. That's why we have to run credit to get you fully pre-approved. We can't just take your credit report, okay? Now, if you have compensating factors, like you've got $1 million cash in the bank, right? You've got great income, but you had some credit issues, and your mid-FICO score is a 688, okay? When I run that automated underwriting system approval, it's very possible because of that compensating factor of having a lot of money in the bank that I can get you approved, okay, at a higher than a 45% debt ratio, okay? So if you have compensating factors when we're doing a loan application after I run credit, let me know what they are, and let me try and see if I can problem solve there to get you guys approved at a higher DTI if I need to. Now, this is the best part about this. We have a credit analyzing software. It's listed right on the credit report when we run credit, and it'll show you on there that Experian, potential score improvement, 58 points. TransUnion, potential score improvement, 28 points. It'll show on there that there's a potential score improvement. I have my assistant, Kendall Brown, obviously at no cost to you, run a credit analyzer through Cisco. It literally is very detailed. It says, pay down Amex card by $2,000, score will increase 18 points, right? Open a new trade line because you only have one trade line. You're a foreign national and you only had credit for 1 year. Open another credit card, put a $10 balance on it, let it ride for 30 days. Score will go up 38 points. It's that detailed. I have had someone throughout the loan process have a 682 mid-FICO score, getting a 4.875% rate, paying a point, end up getting a 4.625% rate, paying a half point, because we got her mid-FICO score to a 718 within a 30-day period while we were doing the purchase and still closed on time. So whether you're getting pre-qualified and we want to get the scores up ahead of time, or you're already even in escrow, always ask me about this, and I'll obviously advise you too. I mean, if your scores are below 720, I'm going to analyze your credit for you. okay? We're not a credit repair company, okay? But a lot of times people don't understand that how important that your balances that you have on your credit cards impact, rather how much correlation there is between that and between what your credit scores are. So very, very important stuff to review. And again,
Muy
it's listed right on your credit
importante.
report.
Sí.
Okay, what you need to know to get 10 finance properties. You know, most of our investors, I mean, quite literally, you guys, because the market's been so good for the past several years, I mean, they already have 4 lines. So many of you are already in this category right now. I'm really hoping we can open it up to 20 finance properties soon. I know that there's been some verbiage coming across from Fannie Mae on this, but right now it's still capped at 10. So for your 5th through 10th finance properties, again, you got to have a mid-FICO score of 720. You must have 6 months of PITI in reserve for each property. That means principal, interest, taxes, and insurance on a monthly basis. We need to have 6 months of that in reserve, okay? Retirement accounts do qualify at 70% of the amount you have in your retirement account. So those can be used as assets for reserve. And rental income, going back to this point that I had on a different slide, going over DTI. You're going, Reed, I'm already at a 45% DTI. How the heck am I going to qualify to go and buy another property? Because we can use 75% of the projected monthly rental income to offset the new monthly PITI payment. A lot of these properties don't only pay for themselves, they add $100 or $200 a month onto your income. When you're buying a fourplex in the net worth that rents for $4,400 a month and your monthly PITI is $3,300 or $3,400, you're adding about $450 a month onto your income. I have school teachers that make $5,000 a month that have 10 properties based off the fact they have great credit, they manage their properties and their finances correctly, they save correctly, and because they can use 75% of the projected monthly rents to offset the new monthly payment. That's never going to go away. The reason why is because they make you put 20 to 25% down on investment property for a reason, right? Because you're stable and because the note, right, can be sold if you default, and the lender's not going to take that big of a loss or even any loss because you put a lot of money into it. So for that reason, they're lenient with you here. The government is lenient on investors. Fannie and Freddie are more lenient than you think on investors. That's never going to go away. Okay? The max debt to income ratio, if you've already got more than 4 finance properties, regardless of compensating factors, I have not been able to, generally not been able to get it approved above 45%. You can only, this is huge, because I have so many people that go and they rush and they buy 6 or 7 properties, and then they want to pull their cash out of those properties to go and buy more homes. The problem is that Fannie Mae, Freddie Mac, if you want to get low rates, they will not allow you to pull cash out once you have more than 4 finance properties. You can only pull cash out of your primary residence at that point. So please be aware of that. You may purchase or refinance a primary residence regardless of the amount of finance properties you have. You could have 30 finance properties, we can still do a primary home. This only applies to investment property. And then 15 and 30 are fixed available only. We actually have a 20-year and a 25-year now that is available on this loan product. This is the only loan product out there that allows you to go through 5 through 10 finance properties. It's through Fannie Mae. There's nothing else out there like it that has these types of interest rates. Okay, so just to quickly go through the loan process with you guys after you're already in escrow. I know many of you have already bought property, so just bear with me. But I like to just go over this again so everybody knows. You're fully pre-approved, right? You guys send me over a copy of the purchase contract. We're ready to go. We're going to need a copy of the earnest money check, an updated bank statement for the account you're going to be using for your down payment and closing costs. You're going to want to order the home inspection right away, okay? If we get in a bad home inspection for some reason, because you never know what's under the skirt of the property until you get a home inspection, okay? The appraisal is more on the exterior. The home inspection is the interior, right? The piping, what's going on behind the walls, okay? When we get in that home inspection, then I will order the appraisal. These appraisals are not cheap, and we don't mandate the cost of them. We have to order it through our third-party management company, right, that Fannie Mae, Freddie Mac approves. Otherwise, the loan is not able to be sold to them. And we're a direct lender. We sell direct to the GSEs, okay? So very, very important, they require a Form 442, which is a rental comparable analysis, which is good for you because it shows you, from a third-party standpoint, what are these homes really renting out for? Not just what the internet says or what the agent's telling me or what the network's telling me. What are they renting for? That document costs $150 to $200 depending on the market. The appraisal for an investment property is about $400. So again, very important, order the home inspection right away, get that in, review it. Once that's good, we'll then order the appraisal, okay? The day 1 through 7, escrow is obviously going to open. We will be requesting a copy of your HUD closing statement, or rather an estimated HUD closing statement from escrow. That's going to list on there the exact third-party costs, like title fees, escrow fees, okay? The seller selects the title and escrow company on a purchase transaction. So when we initially disclose your loan on this day 1 through 7, the only fees that are going to be applicable are your lender costs on there and your interest rate. All the third-party fees are going to be disclosed high, because if they're not disclosed high enough and they come in higher than what we disclose, we have to eat the difference, okay? So just know we will request that estimated HUD right away, and we'll have it within 3 to 5 business days and forward that off to you, and that way you can get a very detailed idea of exactly how much cash it's going to cost you to close, with down payment, with your impounds if you decide to set up a tax and insurance escrow account with the lender to be paying your taxes and your insurance monthly. You know, whenever you close, you're going to have to deposit funds, right, with the lender for that. So just very detailed on the HUD. That's what you need to know, is the HUD is the most important document here, because that's what's going to list the cash to close, give you a good idea of, hey, this is how much money it's going to cost us to close this loan. Now, the loan is also officially disclosed, okay? It'll be disclosed before we order the appraisal, okay? And in the amount of time that we're waiting to get back to home inspection, my assistant Kendall will be buttoning up your file with you, emailing you an updated needs list with anything else that we need from you at that point, updated pay stubs, because you might not find a property within 30 days, whatever is needed. Now, once we get back to the appraisal, okay, which to go on to the next page, appraisal will take 3 to 5 days to get back from the date that we order it, okay? We order it through the AMC. Again, why is that important to you, that we order it through a third-party management company, which we can't talk to prior to completion of the report? Because it allows you guys to know that, hey, no one has influenced the value of this appraisal. Okay? Fannie Mae and Freddie Mac do not want to buy mortgage notes that have been influenced by real estate agents. Okay? They're not going to do that ever again. Look what happened in 2004, 5, and 6. So for that example, it's good. I used to not like this process because it takes more time, but in fact, being an investor, I think it's vital. Okay? It takes 3 to 5 days to get that back. Once we receive the appraisal report, we will then submit the loan for final underwriting approval. It takes 24 to 48 hours to get that loan approval. We may have 1 or 2 more documents that are needed at that point, depending on how complex that your file is. We'll then request those documents from you, get those from you, and then submit your loan for a clear to close. Okay, that's day 8 through 15. And this is if you got fully approved up front. If you come to me with a purchase contract and you didn't get pre-approved yet, we'll still have the loan done within 21 to 30 days. But again, it's going to be done a lot faster and a lot smoother if you get pre-approved up front. The last steps after we get the clear to close, before we draw docs, you see how these docs are drawn. Before we draw docs, I'm going to be sending you a copy of the final HUD closing statement from docs, okay, on our end. That way, you guys can review it before you sign your final closing documents. We'll review it over the phone together. If you have any questions, we'll go over it then. That way we know all the numbers line up based off of the rate lock that we agreed on, and all the terms are all correct. So when you guys do sign your final closing documents, there's no hiccups. Okay, we don't want to deal with that. What will then happen after docs are drawn to the escrow company? The escrow company will then call the notary. Right? We use a traveling notary service to come to you. So if you're buying a home out in Texas, unless you want to be there for the signing, we will have a notary come to you at your home or place of business, 9 o'clock at night, whatever you need us to do. They're very good. I've had people sign loan documents while they're on vacation in New York at 11 o'clock at night at their hotel. Okay, it's literally that's how it works. Notary will sign documents with you. I'll be available while you're signing your docs in case you have any questions. Okay, after you're done signing, the documents are then mailed, or if we have to fund the following day, we actually will allow you to fund off scanned documents. So we'll have the notary scan the documents to the escrow company. They will then scan the documents to my funder, Holly Boyle. Holly will then fund your loan the day after, okay? You will need to wire in your funds to close after you sign before we can fund your loan, okay? But again, if you get fully pre-approved up front, the closing process should take you 21 days or less, depending on your loan file. some frequently asked questions. I already went over this. Again, I think it's just such an awesome ruling is that we can use 75% of that gross rental income to offset your new monthly payment. It's huge. And then I did already go over the 442 with you. How do we factor the rental amount if the home is not pre-leased? It's because of that Form 442 document that's included with your appraisal. It's the rental comparable analysis of all the properties in the area that are just like yours that you're buying. Okay, I'm going to let Tanya take over from here. The new website is just monumental in our network. I love it. And she's going to go over just a few things here with you, and then I'm going to go over a good faith estimate. Okay, so Tanya, you want to take over?
Yeah, sounds good, Reed. Okay, so I know that we have introduced this website to a lot of members, and some of you may not have seen it or you're new. So if you go to our website at mrren.com, where you registered for this event, you just hover over the Investments tab, and you can make it as unique a search as you like or not, and view all 75 properties that we have on our website. What's really cool about this is it gives you an overall view of what you need as far as down payment. Down payment is this investment capital for finance purchase, the cost, and so when you go ahead and say, like on this top property, you click on that picture, you can then see, Reed, if you can go to the next slide, it will make it a lot larger. So we've kind of made this very user-friendly for you. Off to the right on the bottom, you see the map. If you click on that, you can see the area in full, see what's nearby there. You can do Google Maps. But if you have any questions about any specific properties, you can either contact your real estate advisor that you're currently working with, or you can go ahead and fill out that information saying, I want to learn more information about this market or this property up at the top right, and then hit Contact Real Estate Advisor. One of us will get back to you within less than 24 hours, if not within the hour, during business hours. It gives a little description, and then, Reed, if you can click the next tab, it gets really detailed. So you guys that have come to our events and we give you the handouts of what the property profiles look like, this is the Excel spreadsheet that we have used for the past couple of years. Now we're letting you guys be able to play with it as far as down payment. See up at the very top, it says financing, and then right next to it, there's like an invisible tab that says cash. So in some of our properties, we have seller financing available. So next to the cash would be a seller financing tab. All of these are calculated with the rates in which we are providing, but you can see on the down payment, see how the box is, you're able to edit it. With investment properties, you can put down 20 or 25%. You can even see what it would be like if you put down 40%, which would increase your cash flow. So then if you go down, you can see investment capital needed, the debt service, so that'll show you what your mortgage payment would be, all based off of the numbers that you edited on your down payment. You can change the term of years, and most importantly, the interest rate. We use, as a standard across the board, 4.5%, because if you have good credit, that is what it should be or less, right? Depending on everything that you own, how many properties you carry, etc., that will be determined, which Reed and his team at AmeriFirst will be able to share with you what your interest rate will be, which dramatically affects your cash flow. So everything is on here. You can change the vacancy rate if you want to make it more conservative. We already have it at 8%. The leasing fee is basically half of the first month's rent that we've calculated out over a 1.5-year time frame. So all these things you can edit on your own. Reed, if you can go to the next tab. Thank you. So, and then when you check out everything, it shows the cash flow. As you can see, we have the monthly cash flow and the annual. So this is the basic breakdown. If you wanted to up or lower the annual appreciation of the market, you can. Number of years held to determine your return on investment, you can put that to 5 years, 3 years, and that will show you what it is. And at the very bottom, it's important to see the high detailed financials. In the very beginning, you will see it to say expand detailed financials. But all of our properties on our website have this now. It's a very wonderful feature for you guys to be able to control and browse and look at the pace that you would like. And then if you could go to the next slide, I think I have one. Oh, this is you. So that is how our website is working for you. A lot of our investors are very excited about this, and we've been getting tons of inquiries. So it's very up to date. As soon as it's contracted on, we either hide it on the site so that we're not wasting your time. But either way, even if you do like it and it did get contracted, I will be on top of it to help you get another one, of course, if you're pre-approved with a great lender like Reed. All right, Reed, it's all you.
Okay, thank you so much. Okay, yeah. So just this is a copy of a good estimate. This is so everybody should always be receiving a GFE. Just so you guys understand, again, right-hand side title charges, right? Escrow, signing fee. Those are the only fees that are going to be estimated up front. Again, you're going to have those on the estimated closing statement that we request after you open escrow. But we charge $16.50 processing and underwriting fee, and then we give a $400 lender credit to all preferred Marshall Reddick clients. So total lender costs are $12.50. If you want to get about a quarter lower in rate, you guys can pay a point. I would advise, because most people sell or refinance within 5 years, probably better to go with a no-point loan. We can discuss all that, though, on our loan consultation before we disclose your loan. And then if you see here, I really want to point this out. You're not just coming in with your standard closing costs and with your down payment, guys. If you look at the very bottom, actually, let's go to the line item 900. Items required by lender to be paid in advance. Let's go to line 903. Hazard insurance. You're always going to have to prepay your first year of homeowner's insurance on any purchase transaction. Okay, that could be $500 or it could be $3,000 if it's an expensive home here in California. So that's an additional cost you're going to have to come up with. Prepaid interest. Okay, if we close your loan on the 25th of the month, you're going to prepay interest to get you through to the end of the month on a daily basis. Then you're not going to have a payment due until the first of the following month. That's because interest is paid in arrears. Whereas if you're renting a property, you prepay for your rent up front the day that you move in. Not the same with a mortgage, right? You're going to move into the home on the 1st. You're going to accrue interest every day thereon through the end of the month, and then your first payment's due the 1st of that following month. Okay, so you're going to have some prepaid interest depending on the day that you close in the month. Now, if you want to set up a tax and insurance in-pound account, so that way every single month you're paying a monthly portion of your taxes and your insurance with your monthly principal and interest payment, and you don't have 2 large payments a year for taxes and 1 large payment a year for insurance, it's very easy. You'll need to deposit roughly 6 months of taxes and 3 to 6 months of insurance, depending on what time of the year that it is, with the lender through the close of escrow. That's an additional cost out of pocket, rather, that you're coming up with. That also affects APR. So just know that APR, that's why APR makes no sense nowadays, because they factor in things like title fees and they factor in things like reserves, okay, which reserves are a cost you're going to pay either way. It's taxes and insurance, okay? Now, I don't advise doing this if you're buying $1 million home in California, because that's like $12,000 in taxes divided by 2. So that's $6,000 in taxes that you're basically giving to the lender when you could have that money working for you in the market, right? You could be investing that money. But when it's only $60 a month for insurance and $100 or $150 or $200 a month for taxes, I do think that if you're buying multiple properties to keep things more streamlined, an in-pound account does make sense. Or if you're working with limited funds and you want to make sure that, hey, you don't have to pay a $5,000 a month tax bill or $3,000 a month tax bill every single 6 months on your primary home, and you'd rather just pay it monthly, okay, and use this as kind of a savings account, definitely a smart thing to do. And some people like them, some people don't. But that's why we go over that initially in our loan consultation, or rather even when you open escrow, so that way this is all figured out ahead of time and there's no surprises at closing. Okay? Everything else on here is pretty to the point. appraisal fee, it's going to be about $600 on investment property. I always put $450 on here because depending on if it's a primary home or not. And I also want to point this out. If you put 20% down, you're going to have a slightly higher interest rate. It's risk versus reward. Okay, the more money you put into this transaction from a down payment standpoint, you're going to get a lower rate. If you put 25% down, the rate's about a quarter lower. If you put 30% down, no change in rate. So on investment property financing, 25% down is the best pricing that you're going to get. Okay? I think I've gone over everything on here. Okay. And Tanya, if you want to just talk about this property and go through your slides, and then I'll finish it up.
All right, sounds good. Thanks, Reed. So this is one of our new construction properties in Indianapolis, Indiana. We've worked with this builder for many years. As you can see, it was built right here underneath the picture. It says built in 2014. It shows everything about the property. Financing, again, you can go ahead and do the cash. Your cash-on-cash return is 7.32%, which is wonderful. Your annual cash flow, it's all right there. And if you can go to the next page. Here, again, detailed financial analysis. You can, as Reed was saying, buy down or get a lower interest rate by putting 25 versus 20%, and then you can put in your actual interest rate that you qualified for. And it gives you everything all over again. So I went in detail the first time around, so I will spare you guys the details. But as you can see, look at the annual, the very bottom in the blue, the annual cash-on-cash return and for the annual. This is something that is available to you guys. Please feel free to reach out to me, and after you browse over any or all of the properties, and I'll share more market details with you.
Next slide.
I think the next slide, yeah, that's all you.
Again, this is just a GFE based on that. The reason why I put 2 GFEs on here, you guys, is because I just want to point this out. So on this property, right, Indianapolis, we have the insurance at $54 a month and the taxes at $150 a month. But if you come back to this property over here, our taxes are $100 a month and insurance is $60 a month. So just understand that that's why it's so important. Everything changes depending on the market. So in this scenario, the closing costs are going to be a little bit more, of course, because the taxes are a little bit different and the insurance is a little bit different. Again, a $400 credit, it can be applied towards your appraisal or towards your lender fees, whichever that you like. This is a branch credit. It's not coming from your rate in the form of a lender credit. This is a straight branch credit for you guys. I've done probably about 1,000 loans in the network now at this point. I've been in part of the network for over 10 years. I appreciate you guys very, very much and the network, and anything I can do to be of more value, I'm happy to do it. And again, the $400 credit is on every single transaction, whether you're buying a primary home or an investment property. And that's on top of whether or not you decide to go with a higher rate with a large lender credit or go with a lower rate and pay a point. Again, this is separate from that for you guys. I also want to just point out very, very quickly, there's an accountability if you use me that you're not going to have using another lender, simple as that. If you're buying a home in Texas and the Texas lender, you happen to go with them and they're not getting back to you, or the terms aren't the same as where you started, and if you call up the network's going to call the lender and they probably won't even answer the phone. So again, you guys, I get a lot of my business from this network. I consider myself a partner of the network because of the time that I've been there and the time that I spend in the network. And there's an accountability in using me, so please know that I want to take great care of you guys, okay? This is me and my team. My team's actually grown quite a bit. I've got 12 people now on my team. This is my office building here in San Clemente. It's the historic City Hall building, so any of you guys that live in Orange County, and if you guys want to do a consultation in person, I'd love to have you guys come on down. We've got South and Next right across the street. Go have lunch, talk in person. And again, worked very, very hard to get to this point. I grew up in San Clemente, and very, very happy to have an office right here at the top of Del Mar Street. This is all my contact information. This is the link to my website. If you guys want to fill out an application on my website, or you guys want to check testimonials, learn more about me, there's a lot on there. And that's all my contact information. And I'm going to end it out tonight with letting Tanya speak with you guys about the mentoring program that she offers for free through the network. And again, just thank you so much for being on this call tonight. I wish you all a happy 2015, and I hope to speak with you guys. Thanks so much, Tanya. Thanks, you guys.
Thank you, Reed. It's always great working with you. You guys, it's so important to know the accountability of a lender. Being able to reach out not only to me, but Reed works with, as you guys saw in the very beginning, he's licensed to lend in about 4 to 5 states. So of those states, guess what? We're in them. So he's a great place to start with, as well as he works with the agents as well. So everything goes very smoothly for you. I'm a real estate advisor, so what it is that I do here is I work with you to help you set your investment criteria and kind of basically set up your expectations for what to expect. I do everything from basically like a pre-qualification of learning what it is that you want to do, where you are, do you still need to save to get there, and then I connect you with the vendors that make the most sense for you. We can set up a 5-year plan, a 10-year plan. Maybe you guys only want to invest in over the next 3 years. I'll lay out a plan for you. Just let me know what we can do. It is complimentary, as you see. So let me know how we can get started. You can go ahead and email me. This is my email. Of course, I can always warmly connect you to Reed. Do know that I will be sharing this recorded presentation with you if everything went smoothly on the call. I'm going to send it out to you because I know this was so much information. So I'll get that off to you tomorrow. And I look forward to speaking with you guys. I'm working with a handful of you already, and I will answer a couple of these questions personally that you guys wrote during the presentation. All right. Well, Reed, thank you so much again for your time and all your expertise. We love your team. Brett does such an amazing job. So he learned from the best, right? So we will have to get you guys connected and wish you guys all a wonderful evening, and we will talk soon. Thank you. Bye.